Imagine running a business where your profits explode by almost 400% in a single year, but you hardly grew the size of your company at all.
It sounds kind of impossible on paper.
Right. In fact, in some areas, your inventory actually shrank. So today, we are taking a deep dive into a community-based regional bank that pulled off exactly that kind of, you know, financial magic trick.
Yeah, it's one of those situations where the headline numbers just force you to stop what you're doing and look under the hood. We're digging into the first quarter 2026 earnings for RBB Bancorp.
And for context for you listening, this is a regional player with branches in Los Angeles, New York, Chicago, Vegas, and Hawaii.
Right, and if you've been paying attention to the financial news lately, you know that regional banks have been under a massive microscope.
Oh, totally. The narrative is usually just doom and gloom about plummeting deposits, commercial real estate disasters, and just totally squeezed margins.
Exactly. But we have a stack of financial tables and earnings releases here for RBB, and honestly, their quarter reads like a masterclass in dodging every single one of those landmines.
Which is why we need to unpack the mechanics of how they actually did it. Because to your point, they didn't just survive a tough macroeconomic environment. They actively optimized their way through it.
Yeah, they really did.
So before we get into the gears of the operation, we have to establish the baseline. We need to look at the scoreboard so you know why this quarter matters. Net income for the first quarter hit $11.3 million.
Which is a solid number.
Yeah, and that translates to 66 cents per diluted share. And just to quickly pause there, when we say diluted share, we're just talking about calculating the profit per share if every single stock option or convertible bond out there was suddenly turned into regular stock.
Right. It gives you the true worst-case scenario for the math, which makes the next part even more impressive.
Exactly, because compared to the immediately preceding quarter, so Q4 of 2025, that 66 cents is a solid 11% bump.
A nice steady increase.
Yeah. You see an 11% increase quarter over quarter, you think, okay, good job, steady growth. But then I looked at the year-over-year numbers.
Yeah. Comparing
Q1 2026 to Q1 2025, I genuinely thought I was reading a typo.
The jump is just staggering.
It's a 393% increase in net income.
Wow.
And a 408% increase in earnings per share, up from just 13 cents a year ago.
Which is just a massive leap.
Right. Their pre-tax, pre-provision income, which is basically the profit from their core operations before taxes and rainy day funds are factored in, that was $15.5 million.
A 16% increase from the previous quarter.
Yep. And their return on average assets expanded to 1.09%. Okay, let's unpack this. If a retail store suddenly makes 400% more profit, I assume they either sold 400% more shirts or they figured out a way to make the shirts infinitely cheaper. Did this bank just massively balloon its size over the last 12 months?
Well, what's fascinating here is that they absolutely did not quadruple the size of the bank.
They didn't.
No, not at all. If you look at the balance sheet, their total assets only grew by about 4.6% over that entire year.
Oh, wow.
So going with your analogy, they didn't sell 4 times as many shirts. This is a story of ruthlessly optimizing the supply chain and lowering the cost to manufacture those shirts, while perhaps selling them for a slightly higher price.
That makes sense.
And the ultimate indicator of this in the banking world is their net interest margin, or NIM.
Which is the absolute core engine of a bank, right? The difference between what they earn by charging interest on loans and what they pay out in interest to people holding deposits.
That spread is everything. And in the first quarter of 2026, RBB Bancorp increased their net interest margin by 16 basis points, bringing it to 3.15%.
Which, I mean, to a layperson, 16 basis points or 0.16%, it sounds like an accounting rounding error.
Yeah, it sounds tiny, but you have to look at the macroeconomic context.
Right.
In an environment where the yield curve has been incredibly challenging and banks are fighting tooth and nail for every dollar of deposits, squeezing out 16 basis points of margin expansion across billions of dollars in assets is massive.
Because it just drops straight to the bottom line.
Exactly, which is how you get a 400% explosion in profit on only 4% asset growth.
Okay, so if they widened that margin, they either started charging way more for loans or they figured out how to pay less for their funding. And for a bank, funding means deposits. It means the cash you and I keep in their checking and savings accounts.
Right.
But here's where I get a little confused looking at these tables. If their profits are exploding, I naturally assume they're raking in a ton of new deposits to fund that growth, but their total deposits actually shrank.
They did.
Yeah, they're down about 1% from the previous quarter, sitting at $3.34 billion. How exactly does a bank make exponentially more money while holding less cash in the vault?
It seems completely counterintuitive until you look at the quality of that cash.
Yeah.
The overall pile of money got slightly smaller, but the composition of that pile got dramatically cheaper.
Meaning what, exactly?
Well, they let roughly $62 million in wholesale deposits simply walk out the door.
We should probably define that because wholesale deposit sounds like, I don't know, buying money in bulk at Costco.
That's actually not far off. Wholesale deposits are often brokered deposits. That means instead of a local business owner or a family walking into an RBB branch to open an account, the bank is basically buying massive blocks of deposits from third-party financial brokers.
Okay, got it.
The problem with brokered deposits is that they are incredibly fickle and highly rate sensitive. They have zero loyalty to the bank.
Because they're just chasing the best yield.
Exactly.
Yeah.
The second a competitor across town offers a fraction of a percent more in interest, that money just vanishes.
So it's very expensive, high-risk money, and they just let it roll off the books.
Yep.
But while they were letting that wholesale money go, their regular retail deposits, the normal people and businesses, that actually grew by over $51 million.
And that shift alone improves the stability of the bank. But the real margin expansion happened within those retail deposits.
This is the part of the report I found really fascinating. The mix of what people are doing with their money shifted dramatically.
It really did.
Like time deposits, which are things like certificates of deposit where your money is locked up for a set term at a fixed interest rate, those dropped by $168.4 million. People let their CDs mature and they just didn't renew them.
Right.
But the bank's non-maturity interest-bearing deposits, so think of your liquid high-yield savings accounts, those surged by $219.4 million.
Let's synthesize the why behind those numbers, because it's a perfect reflection of consumer psychology right now.
Yeah, what's driving that?
Consumers are looking at the interest rate environment and realizing that locking their cash in a CD for 12 or 24 months just doesn't make sense if they think rates might stay elevated or if they just want access to their cash.
Right, they want options.
Exactly. They want liquidity, but they still demand a yield. So they let the CDs mature and they slide that cash right over into a high-yield savings account at the exact same bank.
So what does this all mean? It's kind of like a subscription service realizing that a ton of their customers are about to cancel their premium expensive tier. So instead of losing them entirely, the company proactively pushes them into a basic, slightly cheaper tier.
That's a great way to put it.
The company makes a little less revenue per user, but they stop a mass exodus. In this case, RBB successfully negotiated a cheaper rent with his own customers without making them so mad that they move their money to Chase or Bank of America.
And we can see the mathematical result of that maneuver. By capturing that consumer behavior shift perfectly, RBB actually lowered their overall cost of deposits down to 2.86%.
Oh, wow.
Yeah, and if you just look at their interest-bearing deposits, they lowered that cost by 12 basis points, bringing it down to 3.39%. They retained the capital, kept the customers happy with liquid savings, and optimized their own costs.
But wait, I have to push back here. From a risk perspective, isn't that incredibly dangerous?
How so?
Well, if customers are moving hundreds of millions of dollars out of locked-in CDs, where the bank knows exactly how long they hold that cash, and moving it into liquid savings accounts, doesn't that pose a sudden flight risk? Like, what if all those customers wake up tomorrow, get spooked by a headline, and just decide to withdraw their cash?
You're identifying the classic liquidity risk that honestly keeps bank executives up at night. The transition from locked-in term funding to liquid funding technically shortens the fuse on a bank run.
Right.
However, the data in this report shows they've built a massive structural defense against that exact scenario.
Okay, what does that defense actually look like in practice?
First, look at their demand deposits. Over 15% of their total deposits, which is more than $500 million, are completely non-interest bearing.
Just sitting there making nothing.
Right, this is pure transactional cash. It's operating accounts for businesses, regular checking accounts. That money is incredibly sticky because people need it to pay rent and make payroll tomorrow. They aren't chasing yield with it.
That makes sense.
Second, and probably more importantly, they report having $2.2 billion in cash, highly liquid investments, and secured borrowing capacity available immediately.
Okay, so even though the depositors technically have the freedom to pull their money out whenever they want, the bank has a $2.2 billion fire extinguisher sitting in the corner just in case they do.
Precisely. They engineered the cheaper funding without exposing themselves to a terminal liquidity crunch.
Okay, so they've optimized the liabilities. They squeezed more margin out of the depositors by offering them liquid savings. But squeezing yield out of your savings accounts only solves half the puzzle.
Right. You still have to put the money to work.
Exactly. If you're paying depositors 3.39%, you're instantly losing money unless you can turn around and lend that exact same dollar out to someone else at a higher rate. So how are they deploying that capital?
If we look at their loan book, they're holding about $3.3 billion in loans for investment. And the new money they are pushing out the door is highly accretive.
Meaning it's earning a good return.
Very good. They originated $131.1 million in new loans in the first quarter, and those are yielding an average of 6.37%.
Earning 6.37% on money that costs you 3.39% is a very comfortable spread.
Really is.
But here is the absolute shocker in this earnings release. It's the line item for the provision for credit losses.
Yeah, that stood out to me too. For anyone unfamiliar, the provision is essentially the bank's rainy day fund.
Right.
It's an accounting mechanism where the bank takes a chunk of its operating profit and explicitly sets it aside to cover loans they mathematically expect to default in the future.
Right, and if we look back a year to Q1 2025, RBB had to take a massive $6.7 million expense for potential bad loans. That was money sucked straight out of their profits.
Yeah.
But in Q1 2026, the provision wasn't an expense at all. It was a reversal of $200,000. They literally took money out of the rainy day fund and recognized it back onto the income statement.
And if we connect this to the bigger picture, reversing a provision is an incredibly bold accounting move. Bank auditors and regulators despise optimism.
I bet.
You do not get to take money out of reserve unless you have hard, verifiable data proving that your future risk has fundamentally decreased.
So what data gave them permission to do that? Because you can't just guess.
No, absolutely not. A few things. First, their actual non-performing assets, which are the loans that are already in trouble, those dropped 9% quarter over quarter down to $48.8 million.
Okay.
Substandard loans decreased by $2.7 million. They also likely had payoffs on specific loans that basically carried high-risk reserve allocations. But broadly, it indicates that their internal economic models for the next 12 to 18 months are showing stabilizing credit quality.
Here's where it gets really interesting to me. It's like your auto insurance company looking at your driving record, realizing you're a much safer driver than their algorithm originally assumed, and voluntarily calling you up to say, hey, we're going to refund you some of those premiums you paid.
Yeah, it's pretty unheard of.
You just never see it happen. But my question to you is, are they being a little too optimistic here? Like taking money out of the reserve when the broader economy, inflation, and interest rates still feel incredibly uncertain?
It's the exact question an analyst would ask on an earnings call. A $200,000 reversal is a massive statement of confidence. But you have to contextualize it against the total safety net they still have in place.
Okay.
Even after pulling that $200,000 back into earnings, they still hold a very healthy allowance for loan losses totaling $43.7 million.
Which mathematically covers about 1.31% of their entire loan book.
Yes. And more importantly, that allowance covers nearly 98% of their currently non-performing loans.
Oh, wow. Okay.
So they are effectively fully reserved for the problems they know about, with a substantial multi-million-dollar cushion for the unknown problems that might pop up tomorrow. They aren't flying without a net. They and their auditors simply determined the net was a few inches thicker than it actually needed to be.
Okay, the math makes sense. But this bank's optimism about their borrowers paying them back seems completely detached from the reality we are seeing in the national headlines.
It really does feel like a disconnect.
Yeah, if you read any financial press right now, there is a constant beating drum warning about a commercial real estate apocalypse. The dominant narrative is that commercial real estate, or CRE, is a ticking time bomb that is going to wipe out regional banks. Yet RBB is out here reducing reserves. To understand their confidence, we have to forensically examine exactly what kind of real estate they own.
This raises an important question, because you cannot treat commercial real estate as a monolith. The risk profile of a logistics warehouse in Nevada is completely different from a shopping mall in Ohio, which is completely different from an office building in Manhattan.
So let's break down RBB's loan portfolio. 51% of their loans are single-family residential mortgages, people buying houses.
Very safe.
Right. 38% is commercial real estate. Now, hearing that 38% of a bank's loans are in a supposedly toxic asset class sounds terrifying.
Sure does.
But when you lift the hood on that specific CRE portfolio, you see their strategic advantage. 58.1% of their commercial real estate loans are tied to multifamily housing, apartment buildings. Guess what percentage of their commercial real estate is tied up in office space?
It's vanishingly small.
It's 2.6%. They have almost zero exposure to the exact asset class that is causing a panic on Wall Street.
And that disciplined niche focus is exactly how a community bank insulates itself from macroeconomic shocks.
Because apartments aren't offices.
Exactly. The headlines warning of a CRE meltdown are almost entirely driven by empty downtown office towers, the permanent hangover of the work-from-home era. But people still need places to live. A multifamily apartment building with a 95% occupancy rate performs vastly differently and generates vastly different cash flows than a 30-story office building with a 40% vacancy rate.
It's like looking at someone's diet, where they tell you 38% of what they eat is carbs. You instantly think, oh, that's terrible, you're going to gain weight and crash.
Right.
But then you look closer and realize they're eating complex, slow-burning grains like multifamily homes and consuming almost none of the highly processed, empty sugar of downtown office buildings.
The diet analogy holds up perfectly. And we also have to look at the geographic and structural padding on those loans. 47% of their residential mortgages are in New York, and 37% are in Southern California. But the critical metric is the average loan-to-value, or LTV, ratio.
What's that sitting at?
Across that portfolio, it sits at an incredibly conservative 54%.
Let's explain how that LTV actually acts as armor for the bank.
An average 54% loan-to-value means that, structurally, the borrower either put down almost half the purchase price of the property in cash, or the property has appreciated so much that the bank's loan only represents about half of what the building is worth.
That's a huge cushion.
It is. If a borrower defaults, the bank can foreclose and sell the property to recover their cash. Because the LTV is only 54%, real estate prices in New York or Southern California would have to plummet by nearly half before the bank actually loses a single dollar of their principal. It provides a massive structural margin of safety.
I hear the safety argument, and I agree those LTV numbers are fantastic padding, but I have to play devil's advocate here and push back a little bit.
Okay, let's hear it.
I am looking at the data on their non-performing loans, the borrowers who are actually in default right now. They have $44.6 million in non-performing loans. And the footnotes in this release point out that $41.4 million of that total is tied up in just 5 big relationships.
Yeah, 5 specific borrowers or development groups.
Isn't that a dangerously high concentration of headaches? If just one of those 5 relationships goes totally bankrupt, the bank takes a massive hit.
Concentration risk is always something regulators and investors scrutinize, and honestly, it's a valid critique. Having over 90% of your problem loans tied to just 5 relationships means your risk isn't diversified. If one domino falls, it's a very heavy domino.
Right.
However, you have to contextualize that $41.4 million. First, compare it to the size of the bank. We are talking about roughly 1.2% of their total lending.
Okay, pretty small.
Second, compare it to their total shareholders' equity, which sits at over $531 million.
So they have the raw equity padding to absorb the blow.
Exactly. Even in a catastrophic total loss scenario on all 5 of those relationships, which is highly unlikely given the underlying real estate collateral we just talked about, the bank's fundamental solvency is not threatened. It would hurt earnings for a quarter, absolutely, but it wouldn't break the bank.
That makes sense.
Furthermore, from an operational standpoint, managing 5 large problem relationships is often much easier for a bank's workout team than chasing down 500 small defaulted loans scattered across the country.
Let's walk through that. How does a workout team actually handle a massive commercial relationship that goes sour? Because it's not like repossessing a Honda Civic.
Far from it. When dealing with 5 massive commercial developers, the bank's workout team can literally sit across the conference tables from the principals. They have immense leverage to restructure the debt.
Like what kind of leverage?
They can demand a cash-in refinance, forcing the developer to inject millions of their own personal liquidity into the project to right-size the loan. They can sweep the cash flows of the building directly into the bank's coffers, or they can mandate the sale of peripheral assets the developer owns to pay down the principal. It's surgical, relationship-based banking, which is exactly what regional banks are built to do.
So to bring this all together, what we've walked through today is the anatomy of a 393% earnings rebound.
Which is still crazy to say out loud.
Yeah. RBB Bancorp didn't pull this off through sheer luck or reckless expansion. They engineered it by masterfully managing the mechanics of banking. They lowered the cost of their deposits by capturing consumer demand for liquid savings.
Right.
They actively deployed that cash into loans yielding over 6%. They insulated their balance sheet by completely avoiding the toxic office real estate market, sticking instead to housing with massive equity cushions.
Yep.
They reduced their bad assets, successfully justified taking money out of the rainy day fund, and through all of it, they returned $25.1 million to their stockholders in dividends and buybacks over the last 12 months.
It is a phenomenal case study in utilizing margin optimization, hyperlocal market knowledge, and disciplined underwriting to completely outmaneuver a macroeconomic environment that is suffocating their competitors.
If you're managing your own portfolio or even just trying to understand the trajectory of the broader economy, this is exactly why it pays to look past the doom and gloom headlines. Beneath the static grids of quarterly banking reports are dynamic stories of human behavior, real estate trends, and surgical corporate efficiency.
And as we watch agile, community-focused banks tighten their belts, optimize their deposit costs, and elegantly sidestep the commercial real estate landmines terrifying Wall Street, it leaves you with a critical question to ponder.
What's that?
Are these regional players, the ones with deep local ties and the ability to pivot their strategies in a single quarter, quietly becoming the safest financial bunkers for the next economic storm, while the mega banks are simply too big and too slow to move out of the way?
A fascinating question to end on. We'll leave you to think on that.